There's a document the Social Security Administration sends you every year. It's called your Social Security Statement. And if you've never looked at it carefully, you should, because it shows your entire earnings history, your contributions over decades of work, and your projected benefit at 62, at 67, at 70. It looks complete. It looks transparent. It looks like everything you need to make one of the most important financial decisions of your life. But here's what that document doesn't show you. It shows you the number. It never explains what reduces the number. And for millions of American retirees, that gap between the benefit they saw on paper and the check that actually arrives every month is where hundreds of dollars disappear silently, permanently, without a single phone call from the SSA to warn them it was coming. Today, I want to walk you through the 5 things the Social Security Administration calculates about your benefit but never proactively explains. Not because they're hiding anything, but because the system was built to process claims, not to advise you. And that distinction, as quiet as it sounds, is costing retirees an average of $900 a month they had no idea they were leaving behind. Most people approach Social Security the same way. You log into SSA.gov, you see your projected benefit, and that number becomes the foundation of everything you plan. Your budget, your timeline, your sense of security. And that makes sense. It's the number the government gave you. Why would you question it? But here's what I've learned after going through the actual SSA documentation, the policy manuals, the benefit calculation formulas that are all technically public, but written in language that would take a lawyer to decode. That number on your statement is a starting point, not a final answer. It's what you'd receive under a very specific set of circumstances that the SSA assumes but never confirms with you directly. Change any one of several variables: your employment history, your income during retirement, your marital situation, your timing, and the number changes, sometimes by a little, sometimes by hundreds of dollars a month. And the SSA will not call you to explain why. So let's go through the 5 mechanisms. The 5 things the SSA calculates but leaves for you to discover on your own. The first one is the one that surprises people the most because it's not about losing money. It's about money you're not gaining that you could be. It's the COLA compounding effect that almost nobody calculates before they file. COLA stands for Cost of Living Adjustment. Every year, Social Security benefits are adjusted for inflation. In recent years, that adjustment has been as high as 8.7%. Now here's what most people miss. That percentage applies to your base benefit, which means if your base benefit is larger, your annual dollar increase is also larger, every single year, for the rest of your life. Let me show you what that means in real numbers. Say you file at 62 and your benefit is $2,200 a month. Your spouse waits until 67 and receives $3,400. In the first year, a 3% COLA gives you $66 more per month. It gives your spouse $102 more per month. That's a $36 difference in 1 year. Doesn't sound dramatic, but compound that over 15 years, and the gap between those two benefit trajectories isn't $14,400. It's closer to $22,000 because the larger benefit keeps growing faster in absolute dollar terms every single year. The SSA statement shows you the projected benefit. It never shows you the projected COLA trajectory. It never shows you what your benefit will look like at 78, at 82, at 86. That calculation is yours to do, and most people never do it. The second mechanism is one that catches working retirees completely off guard. It's called the earnings test, and the SSA does mention it in a general information document that most people skim once and forget. Here's how it works. If you file for Social Security before your full retirement age and you continue earning income from work, there's a limit. In 2025, if you earn more than $22,320, the SSA withholds $1 of your benefit for every $2 you earn above that threshold. So if you're collecting $1,800 a month and you earn $40,000 that year, you're looking at roughly $8,840 in withheld benefits. Nearly 5 months of checks gone. Now here's the part the SSA almost never explains clearly enough. Those withheld benefits aren't entirely lost. When you reach your full retirement age, the SSA recalculates your benefit upward to account for the months where benefits were withheld. So there's a partial recovery, but the timing disruption is real. The cash flow impact during the withholding period is real. And the number of people who file early, keep working, and then discover this rule only after they've already lost months of income is significant enough that it belongs in this conversation every time Social Security timing is discussed. The third mechanism is the one that affects a specific group of Americans who often don't find out until it's too late to do anything about it. It's called the windfall elimination provision. And if you spent any part of your career working for an employer that paid into a pension instead of Social Security, a school district, a state or municipal government, a public agency of any kind, this rule may apply to you. Here's what it does. The WEP reduces your Social Security benefit if you receive a pension from a job where Social Security taxes weren't withheld. The reduction can be as much as $587 per month in 2025. Not a small number. And the SSA does include information about the WEP in their general documentation. It's technically available, but it's presented as a general policy note, not as a personalized warning that shows up on your statement with your name on it and the exact dollar amount it will reduce your specific benefit. So what happens in practice is that teachers, firefighters, police officers, state employees, and federal workers file for Social Security expecting the number they saw on their statement, and then the first check arrives several $100s lower than projected. They call the SSA, and the answer they receive is that the WEP was applied correctly and it was disclosed in the documentation, which is technically true, but technically true and actually understood are not the same thing. If you have any public sector employment in your work history, you need to calculate your WEP impact specifically before you file, not after. There's also a companion provision called the Government Pension Offset, or GPO, that affects spousal and survivor benefits for people in the same situation. If your spouse worked in a non-covered government job and receives a government pension, your spousal benefit from their Social Security record may be reduced by 2/3 of their pension amount. In some cases, it eliminates the spousal benefit entirely. These two provisions together, the WEP and the GPO, represent some of the most significant and least understood reductions in the entire Social Security system. And they hit people who spent decades in public service, people who did everything right, at the moment they expected to receive what they earned. The fourth mechanism is quieter but compounds over time in ways that are genuinely painful to discover retrospectively. It's the tax window that most retirees either don't know exists or don't take seriously until it closes. Up to 85% of your Social Security benefit can be subject to federal income tax. Whether it is and how much depends on what the IRS calls your combined income, your adjusted gross income, plus any non-taxable interest, plus half of your Social Security benefit. If that combined number exceeds $34,000 for an individual or $44,000 for a couple, up to 85% of your benefit is taxable. Now here's where the timing matters. Many people retire and then delay Social Security, which is often the right strategic move. But during those early retirement years, before required minimum distributions kick in from IRAs and 401ks, their taxable income is temporarily low. That window, sometimes 3 years, sometimes 5, sometimes longer, is an opportunity. Filing for Social Security during that period, when your combined income is lower, means your benefit is taxed lightly or not at all. Wait until your RMDs begin, and suddenly your taxable income jumps significantly. Now your Social Security benefit, which you've been holding back to maximize the monthly amount, is being taxed at a rate that quietly erodes a meaningful portion of that maximization. This is not a simple calculation. There's no single right answer. But ignoring the tax dimension of your Social Security timing is always the wrong answer. And the SSA, whose job is benefits administration rather than tax strategy, will not raise this with you. The fifth mechanism is the one that affects married couples most directly and most permanently. It's the spousal and survivor benefit coordination gap. The SSA explains that spousal benefits exist. They explain that a surviving spouse can claim the higher earner's benefit after death. What they almost never do is sit down with a couple and model the full household scenario. What happens to total household income at various filing ages? What the survivor benefit looks like depending on who files first and when, and how the decision made by the higher earner today becomes the foundation the surviving spouse will stand on for potentially decades. Let me make this concrete. A woman whose husband files for Social Security at 62, instead of waiting until 67, will receive a smaller survivor benefit if he dies before her. Not temporarily smaller, permanently smaller, for the rest of her life. The difference between a husband filing at 62 versus 67 can translate to $400, $500, sometimes $700 less per month for a surviving wife who may live another 20 or 25 years after he's gone. That's not a planning detail. That's a life-defining number. And it is almost never the centerpiece of the conversation when couples sit down to think about Social Security timing. Now I want to tell you about someone who represents what happens when these mechanisms stay invisible until after the decision is made. She was a public school teacher for 28 years in a state where teachers paid into the state pension system rather than Social Security. She also worked part-time jobs throughout her career that did pay into Social Security, so she had a legitimate work record and a legitimate projected benefit on her statement. She saw that number. It looked reasonable. She filed at 63. 6 months later, her first check arrived, $490 lower than the projected amount. She called the SSA. She was told the WEP had been applied because of her teacher's pension. She asked why she hadn't been warned more clearly. She was told the information was available in the documentation. She asked if there was anything she could do. The answer was no. The filing decision was final outside of a narrow 12-month window to withdraw the application, which had already closed. $490 a month, every month, for the rest of her life. Not because she did anything wrong, because a mechanism that affected her specifically was disclosed in general terms and never made real until it was too late to act on it. So here's what you need to do before you file for Social Security. 3 questions that every retiree should be able to answer with specific numbers, not general impressions. First, does your work history include any employment in a sector that paid into a pension instead of Social Security? If yes, calculate your WEP reduction specifically. The SSA has a WEP calculator on their website. Use it with your actual numbers before you make any filing decision. Second, what will your taxable income be in the year you plan to file? This includes any pension income, any part-time work, any investment distributions. That number determines how much of your Social Security benefit will be taxed and whether it makes financial sense to file this year or to wait until a lower income year. Third, if you are married, have you and your spouse modeled the survivor scenario? Not generally, specifically. What does the surviving spouse's monthly income look like if the higher earner files at 62 versus 67 versus 70? That number, the survivor's monthly benefit, is the most important long-term output of your Social Security timing decision, and it is almost always the least discussed. The Social Security Administration is not your adversary. The statement they send you is accurate. The benefit they calculate follows the rules as they were written. What the SSA is not, and was never designed to be, is your personal financial advisor. The system was built to administer benefits for tens of millions of people. It was not built to walk each one of them through the specific implications of every mechanism that affects their specific situation. That gap between what the system provides and what each person actually needs to understand before filing, that gap is real, it is significant, and it belongs to you to close. The 5 mechanisms we walk through today are where that gap lives. The COLA compounding you never projected, the earnings test that reduced your cash flow when you kept working, the WEP that arrived without a personal warning, the tax window that opened and closed while you were focused on something else, the survivor benefit that will define your spouse's financial life for decades after you're gone. None of these are hidden. All of them are consequential. And the only thing standing between you and understanding them before they affect you is knowing they exist and knowing the right questions to ask.